Well, folks often ask me about the secret sauce, the one thing that made all the difference. And I usually just tell them it's pretty simple: common sense, patience, and avoiding dumb mistakes. But the truth is, I've made plenty of dumb mistakes myself. Believe me, I'm living proof that you can make a lot of money in this world by just not being quite as dumb as the other fellow on occasion, and by learning from your own bonehead moves. Let me tell you about one of my biggest ones. Back in the 1960s, I was running my partnership, the Buffett partnership, out of Omaha, Nebraska, and I was looking for undervalued assets. I stumbled upon this textile company called Berkshire Hathaway. It was a dying business, really, with these old textile mills up in New England. But the stock was trading at a price well below what the underlying assets, even in liquidation, seemed to be worth. I started buying shares in 1962, initially paying around 7.60 a share for what looked like a classic Ben Graham cigar butt, just enough puffs left to make it worthwhile. The management, led by Seabury Stanton, had promised to make a tender offer for some shares at $11.50. So I kept buying, anticipating I could sell my block to them and make a quick profit. I thought I had him over a barrel, you see. I figured he needed my shares to complete his plan, and I was going to squeeze out a nice return. Well, Seabury, he came back with an offer of $11 at 37.5, a quarter of a dollar less than what he'd implied. I was furious. What a dumb emotional response, but I was green in some ways back then. I decided right then and there I wasn't going to sell to him. Instead, I bought more shares, took control, and fired him. What a bonehead move that was. I poured good money after bad, trying to salvage that textile operation for another 2 decades, investing capital that could have been earning fantastic returns elsewhere. We ended up shuttering the mills, and every dollar I put into those textile mills was a dollar I couldn't put into See's Candies or American Express or Coca-Cola. It was a classic example of letting emotion, specifically spite, dictate a business decision. I still look back and think about how much that textile business cost me in opportunity cost over the years. My best guess is it cost Berkshire shareholders at least $200 billion over the following decades by diverting capital and my time from far superior ventures. I call it my $200 billion mistake. Here's what I learned from that mistake. This is a lesson Charlie Munger has been trying to pound into my head for 50 years. Buying a statistically cheap business in a declining industry is often a terrible idea, no matter how cheap it is. Ben Graham taught me to buy dollar bills for 50 cents, and that's a fantastic principle. But Ben didn't always distinguish between a thriving, growing dollar and a dollar that was slowly but surely decaying. You want to buy a dollar bill, sure, but you want that dollar to be growing into $5 or $10 over time, not shrinking into 75 cents. It's like owning a farm. You don't just buy a farm because the land is cheap. You buy it because you understand what it produces, the corn, the soybeans, the cattle, and you have a good sense of what those products will be worth over time. You want fertile land, not a swamp, even if the swamp is dirt cheap. You can drain a swamp, sure, but it's a lot of work and often not worth the effort. The same goes for business. You want fertile ground where your capital can grow, not a place where you're constantly fighting an uphill battle against economic forces. You don't need to be a genius to understand this. It's really quite simple, almost too simple for some folks in the investment world who like to complicate things with fancy equations and algorithms. The core idea is that you're buying a piece of a business, not just a stock ticker, and a business has to earn money for you over time. If it's in a fundamentally challenged industry, one that's getting eaten alive by competition or technological change, then even a cheap price might not be cheap enough to save you. You're trying to catch a falling knife, and it's a messy, painful business. This reminded me of when I was a kid delivering newspapers in Omaha. I quickly learned which houses were reliable payers and which ones would make me chase them for a nickel. I wanted reliable, growing customers, not the ones that were a constant headache. It's the same principle in business. You want customers or businesses that are reliable, that grow, that are a joy to own, not a constant source of worry and drain on your time and capital. Berkshire taught me the hard way that even if you can get control of a bad business, it's still a bad business and it will still consume your precious resource. When we finally understood this lesson, thanks in large part to Charlie Munger's clarity of thought, our approach to investing changed dramatically. That's when we started focusing on what Charlie calls wonderful businesses at a fair price instead of fair businesses at a wonderful price. Take Coca-Cola, for example. We started buying Coke shares in 1988, paying about 1.98 adjusted for splits. It wasn't the cheapest stock in the world at the time, but it was and still is a fantastic business. It had a brand name known globally, an efficient distribution system, and a simple, repeatable product. People want to drink Coke all over the world. That's a powerful moat. Our position in American Express is another example of learning from mistakes, but in a different way. Back in 1964, the company got caught in what was called the salad oil scandal. A subsidiary had lent money against collateral that turned out to be barrels of water, not salad oil. American Express stock plunged, and everyone thought the company was going under. Charlie and I went to New York, and I spent days visiting the company, watching people line up to use their cards and traveler's checks. I saw the power of their brand, the trust people had in them. We invested a huge chunk of the partnership's capital, about 40%, around 12 million at the time, and it was one of the best investments we ever made. It was a wonderful business, temporarily mispriced due to a solvable problem. We bought it for about $35 a share, and it rebounded significantly within a year, proving that a strong business can weather a temporary storm. Another example of a wonderful business is See's Candies. We bought See's in 1972 for $25 million. It was a good business, earning about $4 million pre-tax, but it had a lot of qualitative factors we loved. It was a strong brand, primarily in California with incredibly loyal customers and pricing power. When we first bought it, I thought it could do $2 million pre-tax in a few years, but Charlie was far more optimistic. He saw the latent pricing power and brand strength more clearly than I did. See's taught me that a strong brand, a loyal customer base, and a simple product can lead to incredible profitability and capital efficiency. It's generated billions in profit for us over the decades, requiring very little additional capital, allowing us to redeploy those profits into other great businesses. I've held on to bad investments for too long, sometimes, even after recognizing they were poor businesses. My mistake with the Dexter Shoes acquisition in 1990, for instance, I paid $33 million in Berkshire Hathaway stock for it. I thought their competitive advantage was their brand and their distribution. But then global competition came along, and it turned out their manufacturing advantage wasn't a moat at all. The value of the Berkshire shares I gave up for Dexter is now worth many, many billions. I made a huge mistake on the underlying business, and I paid with extremely valuable Berkshire stock. It's an expensive lesson in identifying true competitive advantages. If you're a young investor today, just starting out, here's what I'd tell my younger self and what I tell the thousands of shareholders who come to Omaha for our annual meeting. Keep it simple. You don't need to do extraordinary things to get extraordinary results. What you need to do is understand what you're buying. Imagine you're buying the entire business, not just a few shares of stock. Would you buy the whole company? If the answer isn't a resounding yes, then why would you buy a piece of it? People think you need fancy math, sophisticated computer models, or inside information to succeed in the market, but that's just plain wrong. What you actually need is a temperament that allows you to be rational when others are being emotional, and the ability to understand a few simple business principles. My dad taught me the importance of integrity and common sense, and those are far more valuable than any complex financial model. It's far better to be generally right than precisely wrong, and simple principles tend to keep you generally right. The market is there to serve you, not instruct you. Think of Mr. Market, my old professor Ben Graham's wonderful analogy. Imagine you have a business partner named Mr. Market. Every day, he shows up at your door, offering to buy your share of the business or sell you his, and the price he quotes is often irrational based on his mood swings. Some days he's euphoric, offering to buy your share for a ridiculous price or sell you his for an even more ridiculous one. Other days he's depressed, desperate to sell you his share for pennies on the dollar. The key is to ignore his moods and only transact when his prices make sense for you, when they offer a margin of safety. This applies to any business, not just investing in stocks. What really matters in business is finding an industry that has a moat, something that protects its profits from competitors. Think about See's Candies. Its brand name and quality created a moat. Geico, our insurance company, has a low-cost structure, which is a powerful moat that allows them to underprice competitors while still making a profit. We want businesses so wonderful that an idiot could run them, because eventually that's a bit of an exaggeration, of course, because good management is crucial, but it emphasizes the importance of a strong underlying business model. Charlie always tells me that it's just human nature to try and complicate things. People think they look smarter if they use big words and complex theories. But the truth is, the fundamental principles of good business and good investing are incredibly simple. It's about understanding supply and demand, competitive advantages, and human behavior. It's about sticking to what you know, your circle of competence, and staying out of things you don't understand. I still live in the house I bought in Omaha in 1958 for $31,500, and I drive myself to the office every day. My office on Keyhoe Plaza hasn't changed much in decades. The simple life suits simple principles. But that's not the only lesson I learned the hard way. There's another crucial one about temperament and resisting the urge to follow the crowd. This reminds me of another time when I was just starting out, back when I was filing my first tax return at age 13, claiming a $35 deduction for my bicycle and watch as work expenses. I was always focused on making a buck, but it took me a long time to learn to make a buck in a sensible way. The next mistake cost me even more, not in a single impulsive buy like Berkshire, but in a slow, agonizing bleed of opportunity and misguided effort. My dad taught me the value of a dollar, and I certainly learned the value of compounding early on. I bought my first stock, City Service Preferred, at age 11 for $38 a share. It dipped, I panicked, sold it for a small gain, and then it soared. Lesson learned, patience is key. But then, as my partnership grew, I started trying to dabble in things I didn't truly understand, thinking I could outsmart the market. I made a number of forays into industries that were just outside my circle of competence. Take the airline industry. My initial experience with airlines was pretty dreadful. Back in the 1980s, I made a small investment in U.S. Air preferred stock. I thought I had a decent understanding of the business, but I seriously underestimated the competitive pressures and capital intensity of the industry. It's a business that consumes vast amounts of capital, offers a commodity product, and is constantly battling labor issues and fuel prices. It's a very tough way to make a buck. I famously said that if a far-sighted capitalist had been present at Kitty Hawk, he would have shot down Orville Wright. Paragraph break. I actually wrote in my 2007 shareholder letter that owning U.S. Airways preferred stock taught me a costly lesson in business valuation. I figured it was a heads I win, tails I don't lose too much situation due to the preferred dividend. But I hadn't truly grasped the depth of the industry's woes. What a fool I was to think I could outsmart an entire industry's fundamental economics. It was a stark reminder of Ben Graham's principle of margin of safety, not just in price, but in the underlying business quality itself. There was very little margin of safety in the airline business. Charlie always tells me that you don't get rich by being smart in an easy industry. You get rich by being intelligent in a difficult industry or by being smart and patient and a reasonable one. The airline industry for me was a difficult one, and I certainly wasn't smart enough for it. My investment initially struggled, but we eventually got out okay. However, the opportunity cost of having my capital tied up in a struggling sector was immense. For years, I avoided airlines like the plague, a testament to how deeply that initial experience scarred me. It was a visceral lesson in staying within your circle of competence. Then, decades later, I made a complete about-face and invested heavily in the major U.S. airlines, Delta, Southwest, United, and American. What a head-scratcher that was for many people, especially after my earlier comments. Charlie and I were sitting in the office discussing it, and I convinced myself that the industry structure had changed. Consolidation had reduced the number of major players, and capacity discipline seemed to be, I believe the competitive landscape had shifted enough to make them investable. Well, that decision didn't pan out either, thanks to an unforeseen global pandemic that brought air travel to a screeching halt. I sold all our airline stocks at a significant loss early, and I couldn't sleep at night knowing we held such large positions in an industry facing such unprecedented challenges. I said at our annual meeting that year, when we sell something, very often it's 100% of what we own in the company. That's exactly what happened with the airlines. It was another painful lesson reinforcing the idea that even if the industry structure improves, unforeseen external factors can devastate even well thought out investments. It showed me that my understanding of the airline industry's fragility, despite the consolidation, was still lacking. I was dumb enough to think I could predict a new normal. The truth is, even after all these years, after seeing cycles come and go, I'm still learning. My reading habits are a testament to that. I spend 80% of my day reading, sometimes 5 to 6 hours, just absorbing information, looking for patterns, trying to understand businesses better. I read hundreds of annual reports and 10Ks every year, not just for the companies we own, but for competitors and potential investments. It's how you build up that reservoir of knowledge, that circle of competence. It's not about IQ. I've seen people with 60 IQs fail spectacularly because they couldn't control their emotions or their ego. So, what should you take away from these missteps? First, be fearful when others are greedy, and greedy when others are fearful. When the market is euphoric, like in the late 90s dot-com bubble, that's when you need to be cautious. When everyone else is panicking, like during the 2008 financial crisis, that's when opportunities arise. We invested billions during that time when others were selling everything inside. A long-term position in American Express, for example, which we had held for decades, actually allowed us to capitalize on the financial crisis by making a lucrative investment in Goldman Sachs and others. Second, our favorite holding period is forever. When we buy a business, we want to own it as long as it remains a wonderful business with good management. We're not looking to trade in and out. Think of Coca-Cola. We've owned it since 1988, and it's been a fantastic investment. Same with Geico, which we've owned fully since 1996, but started investing in way back in 1951. It's grown from a tiny niche insurer to one of the largest auto insurers in the country, thanks to a clear competitive advantage and brilliant management, like Tony Nicely for many years. Third, price is what you pay. Value is what you get. The dumbest reason to buy a stock is because it's going up, and yet that's what many people do. They get caught up in the excitement, the fear of missing out. You need to understand the intrinsic value of the business, what it's actually worth based on its future earning power, discounted back to today. Then you wait for the market to offer it at a significant discount to that value. That's your margin of safety, Ben Graham's most important concept. It protects you against the unexpected, against misjudgment, against bad luck. And always remember rule number 1, never lose money. Rule number 2, never forget rule number 1. This doesn't mean you'll never have an investment go down. It means you should construct your portfolio and make your decisions in such a way that the odds of permanent capital impairment are minimal. It means understanding the downside before you even consider the upside. It means avoiding speculative fads and high-risk ventures where the odds are stacked against you. It's really about risk management through rational behavior. Take Apple, for instance. For years, I avoided tech companies, saying I didn't understand them. That's true. I don't understand the intricacies of how they build their chips or write their software. But I started to see Apple differently a few years ago. I saw it as a consumer products company, a company with an incredible ecosystem, incredible brand loyalty, and powerful pricing power. People love their iPhones, they stick with them, and they buy other Apple products. That's a powerful moat, and I understood that. So we made a very large investment. It's a company with a strong consumer proposition, not just a tech gadget maker. It was within my circle of competence once I reframed how I looked at it. It became about the consumer habit, not the circuit board. At Berkshire, we've always looked for these kinds of simple, understandable businesses with durable competitive advantages. We want great management, of course, but even more, we want great businesses. As I often say, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Wonderful companies tend to stay wonderful, and they often grow more wonderful. Fair companies, even if you buy them cheap, tend to stay fair and might even get worse. What really matters in business is quality and the ability to compound earnings over many years. Compound interest is the eighth wonder of the world, as Einstein may or may not have said. I've seen it firsthand from my early days delivering newspapers and saving every penny to running the partnership to Berkshire Hathaway today. The power of compounding means that small, consistent returns over a very long time can lead to truly extraordinary wealth. It's why our favorite holding period is forever. It gives compounding the time it needs to work its magic. Avoiding debt is another critical principle. I've never borrowed significant money personally for investments. At Berkshire, we run with very little debt relative to our asset base and earnings. Too many people get into trouble using leverage, especially when markets get frothy. When things go bad, and they always do periodically, debt can wipe you out no matter how smart you are or how good your underlying businesses are. You don't want to get a margin call from your broker on a bad day. As Charlie says, all I want to know is where I'm going to die, so I'll never go there. And getting wiped out by debt is a sure path to an early grave, financially speaking. So after 60 plus years of doing this, here's what I know for certain about investing and about life, really. It comes down to a few basic principles that stand the test of time because they are rooted in common sense and human nature. I'm 93 now, and if I could tell young investors one thing, it would be this: focus on becoming a better business analyst, not a better market prognosticator. Learn to understand businesses, their economics, their competitive advantages, and the people who run them. I never bet against America. This country, with its entrepreneurial spirit and its free market system, has always bounced back stronger. Despite all the headlines and worries, the long-term trend of human progress and innovation is incredibly powerful. Just pick a broad index fund, like one tracking the S&P 500, and hold it for decades through thick and thin, and you will almost certainly do very well. You don't need to be brilliant. You don't need inside information. You don't need to pick individual stocks. You just need patience, discipline, and a belief in the future. Finally, cultivate a long-term mindset. Ignore the daily noise from the market, the cable news, and the talking heads. Focus on the underlying businesses, on understanding what you own, and on letting compounding work for you. Find joy in the process of learning and growing, not just in the immediate monetary reward. As Ben Graham taught me, the intelligent investor isn't brilliant, but rather patient, disciplined, and emotionally stable. Those qualities are far more valuable than a high IQ, and they will serve you well, not just in investing, but in life.